legislature, a reporter in Washington, D.C., a foreign correspondent reporting from 33 countries, co-partner in a successful Hollywood public relations firm, and a radio talk show host. Lowell, thanks for joining me this afternoon.
Chuck, it is always a pleasure to be with you.
Thank you very much. You know, this is quite timely, your appearance here, and your book, your new book, Don't Bank on It, The Unsafe World of 21st Century Banking, given all of the strange gyrations that are occurring these past 48 hours in the stock market in New York. First of all, give us a quick synopsis of the book, and then tie it into what is going on right now.
Oh, well, we've built our whole society around modern banking and modern computers that have never really stood the test of time. We've only used them a few decades. We found 20 major risks to your bank account that could lose it all or in part, and yet what does the bank pay you for having that account? They pay you nothing. They pay you bupkis. And on top of that, they're on the verge of imitating Europe and starting to actually charge you just to have a bank account. So you will be losing all the way around. There's simply no longer any rational reason to keep very much of your money in a bank account.
And it could even get worse than that. For example, in Cyprus, there was a situation where people were simply told the bank had been closed as a bank emergency, and that even once it reopened, they were only allowed to take out small increments of what they thought was their money. Now, the underlying problem, I mean, it seems to me that the underlying issue here is what's called fractional reserve banking. And I saw in the Wall Street Journal the other day an article that said that Congress is debating whether or not the fraction that would be permitted to big banks with regard to what they can have over the reserve should be raised from 3 to 5%. But if you think about it, this is astonishing. It means for every $5 that the bank has in reserve, they can lend out $100. And they can literally create that money simply by a blip on a computer screen. So just talk about that, how that came about, because people don't realize that.
Well, under King Charles I and then King Charles II in England, the upper classes, the elite, had stored their money with the government for safekeeping in one way or another. And both those kings, at an arbitrary moment, the rich awakened one day to find the government had simply taken their money. And needless to say, after a time, they became exasperated with this. They began looking for someone else who could safeguard their money. They turned to the goldsmiths of London. And the goldsmiths of London, of course, had safes. They had ways to protect wealth because they dealt in gold, all of which seemed great to the rich, who paid them a fee to care for their money. Unbeknownst to them initially, however, the goldsmiths looked at this and said, wow, we've got a safe full of gold, and we've given people receipts, and now they're just using the paper receipts as if they were money. They just swap paper receipts with each other. They don't even come back to ask for the actual gold. Therefore, why don't we lend it out? And so they began lending out the gold that they were supposed to be holding in trust, being paid ample interest for doing so. And that all worked pretty well because they kept enough in reserve that if a few people came in and said, I want my money back today, they could give it to them. But if very many people came back, they suddenly discovered that the money simply wasn't there. As a result, you initiated a thing called bank runs, in which it quickly became the habit of folks that if they saw any trouble on the horizon, if a war was about to break out, if a plague like Ebola were coming, whatever, your first response would be to run to the bank and demand your money while the bank still had enough to pay you. And too bad for the people in line behind you. There might not be money for them. And this became rather complex. In fact, we saw it perfectly described by Jimmy Stewart in It's a Wonderful Life, that great Christmas movie,
right,
where he is Mr. Bailey, the banker, and the people come running to his bank to take it out. And Jimmy Stewart says, well, Joe, don't you understand? Your money isn't in the safe here. Your money's in Mary's house. We lent it to her, and she's going to try to pay us back as best she can. And so the banks were in a position, now legally, to lend out even more money than they actually had, to leave only a small amount in the safe, And the catch was they were basically borrowing short from you and me as depositors. That is, we could come and ask for our money today we could do it by a computer key click in 2 seconds. But they were lending long. They were lending it in 30-year mortgages to people. And so at any sign of instability in the society, people will run to get their money, and it becomes very unstable, potentially disastrously unstable. It's another way of living on margin, the same thing that got people in trouble in 1929 in the stock exchange, where, the shoeshine boy and so on were buying stock by putting down 5 cents on the dollar on margin. And when you do that, you're walking out very far on an economic limb that can break off after you. Now, on top of that, most people were persuaded, well, it's still safe to put your money in the bank because, it's insured by the FDIC, the Federal Deposit Insurance Corporation. You don't need to worry. Well, when we looked into the FDIC, does it have reserves? Yes, it has about $37 billion worth of reserves at any given moment. And it has a vague promissory note from the Fed and the Treasury that in the direst of emergency, those entities might lend the FDIC another $500 billion, which sounds great until you realize the FDIC is insuring more than $7 trillion worth of accounts. So we have fractional reserve banking backed up by fractional reserve insurance that can only cover 1 out of every $14 it claims to insure. When you learn that...
Now, my understanding is that the smaller banks, the credit unions, they are not involved with fractional reserve banking and that they only lend out monies that they have in-house. It's the bigger banks that do this. And that what is the role, for example, of the Federal Reserve? You talked about King Charles I and II of England. My history reading indicates that it was William of Orange who instituted the British Bank of England, and that the Bank of England in 1740s basically outlawed the American colonies' ability to issue scrip, which had been very successful in the colonies. They only were allowed to get Bank of England notes and pay it back in gold and silver, which was scarce in the colonies, and the result was a depression. Now, the Federal Reserve, of course, was the battle between those who wanted congressional control of the currency and those who wanted the private Federal Reserve is a battle that runs throughout all of American history. But the Federal Reserve today, as instituted in 1913, is basically a consortium of private banks and investors, domestic and foreign, and that they have a virtual monopoly not only on the issuance of currency, but on the setting of interest rates, which is how they do it, and of loaning money to the government at interest, money that they create in-house. So can you talk a bit about how that system is supporting the fractional reserve system that exists at the more local and state level amongst banks?
Well, the American banking system, for example, is quite different from the Canadian. The Canadian was always a handful of very large government-supported banks. So they've never had a serious bank run in Canada in their entire history. We created a system of local banks. Let's see, at the time the Great Depression happened, for example, we had more than 29,000 banks in the United States, almost all of which just had one branch, their home branch. So you would have the county bank of so-and-so, and it would be backed by the local and state government, and they would usually require the bank to buy local or state government bonds to back their accounting, which meant it became a very cozy arrangement for the government to get money. And that became tremendously unstable because any pressure at all on those banks, and they could snap like a twig. They did not have huge reserves the way the Canadian banks did. So we did have the advantage in the U.S., though, that our money was generally gold or silver. And to the extent that it was, you didn't need a Federal Reserve because, after all, the money was self-regulating. The government could not just print money willy-nilly, for example, unless it could back it with more gold and silver that the government usually didn't have. So you wound up with a very different financial system here. The founders, however, from the experience of the Revolution, that they had to fight by printing money. They didn't have access to British silver and gold anymore. They did not like paper money. They went out of their way to create real solid money of gold or silver that would then be stable, that had inherent value, that you didn't need to have, for example, an interest rate regulator helping manipulate the supply of or print more of. However, in 1913, in this long historic battle that existed in the U.S., it was a battle between those who wanted to borrow and those who wanted to lend. The lenders wanted stable money, so they'd be repaid with dollars worth as much as they lent out in the first place. The borrowers preferred things like greenbacks, issued by President Lincoln during the war between the states. Greenbacks were not the same thing as dollars. Greenbacks were the currency they paid the soldiers and so on that were backed by nothing. They were like today's money backed. They were basically a faith-based currency backed only by the full faith and credit of the government. You couldn't trade them for gold or silver. And interestingly, during the war between the states, the government would not accept greenbacks as payment for most of its taxes, like tariffs and imposts. Mm-hmm. They demanded gold and silver in payment, which tells you how much faith they had in their own currency. However, to speculators and borrowers, the greenback was heaven, because the government kept printing them. This means you could borrow $1,000 worth of greenbacks and pay back greenbacks worth only $400 or $500. It was fabulous for borrowers or for farmers in the West and so on. So a lot of the populist movement actually called itself things like the Greenback Party, the Inflationist Party. They deliberately wanted the government printing more and more money, and that's what they got under Woodrow Wilson in 1913. They finally got the Federal Reserve, whose very charter in its opening line says, your purpose is to furnish an elastic currency, meaning no more of this nasty solid stuff that the politicians aren't free to print. We now want much easier money. And since then, today, the dollar in your pocket, the Federal Reserve note, has about 2 pennies of the purchasing power of a 1913 dollar.
21st Century Banking, co-written by Craig Smith. Lowell, the issue, I think, it seems to transcend just a matter of a commoditized currency in the form of gold and silver coin, because my look at history indicates that gold and silver coin also can be manipulated by governments in its value as a way to either inflate or deflate the currency over and above or under production. I mean, this is a problem that goes back to the Roman Empire. If you take a look at the history of each of the Roman emperors, they often made decisions with regard to, devaluing gold or devaluing silver as a way of inflating the currency. And in fact, toward the end of the pagan Roman period, inflation was rampant because emperors were deflating currency in order to build more palaces and infrastructure that was not necessarily in the interest of the country. And the result was that the value of the gold and silver currency fell just like the value of fiat currency fell. So I'm not sure the problem is necessarily whether the currency is either fiat in the terms of paper or gold and silver. The problem is the government either issuing too much or too little of that currency above and beyond or under the actual production of an economy.
Well, what folks like the Emperor Diocletian did is, like so many before him, you're right, they would debase the currency. That is, they would take a coin that was 90% gold and they'd remelt it, they'd mix base metals with it. They would then issue a coin that looked similar, but had only 50% or 20% or 5% as much gold as the previous coin had. The Roman Empire, by the way, at least in the Eastern Empire, did hold itself up for many centuries because it issued a very solid gold coin that was reliable, so reliable that the Islamic world actually issued an imitation of it. It was called the Byzant, popularly. But you're right. Countries, when they begin debasing the currency, are endlessly tempted to just make more and more money for themselves. The difference today is we've done it initially with paper so badly that Thomas Jefferson once said that paper money is only the ghost of money. It is not real money itself, by which he meant the only thing that really is money is gold or silver. Or as J.P. Morgan put it in 1912 before Congress, gold is money, everything else is credit. However, it was fiat money in the sense that the government would say, to pay your taxes, you must use our official money. In fact, Diocletian, as we talked about in one of our earlier books, actually put forth a standard for how much people could charge in the official currency for one thing or another, and they were required to use the official currency. One of the interesting things of the Diocletian statements is writing, you can charge 20 drachmas for. Really good writing, you can charge 25 drachmas for. So they were even literary critics in those days. The difficulty is we don't even have money that exists in banks anymore in a direct sense. That is, your money today isn't in a bank safe. It's in little electronic blips in the bank's computers. And God help us if anyone can get in and manipulate those blips. This is why, for example, former Harvard economics professor Terry Burnham, the beginning of this year, withdrew his $1 million in life savings from one of the big banks. Because right now, Chuck, we live in a world where in China today, as we sit here, there are 125,000 people in the Chinese army who get up every day, and their only job as cyber warriors is to sit in front of a computer screen and hack into Western computers, including banking computers. We just saw J.P. Morgan Chase acknowledge that 76 million household data packets had been hacked from its computers, not with the most sensitive information, but certainly with more information than people ever thought they'd be revealing when they gave it to J.P. Morgan Chase. So these are the dangers that we face. We saw China.
Oh, no, it's yeah. I saw on 60 Minutes the FBI director got on and said this is the biggest crisis that this country is facing right now, which is cyber terrorism from China.
In fact, when he was Defense Secretary, Leon Panetta said what we now face potentially is an electronic Pearl Harbor. At any time, all they have to do is crack our computers, and they can bring down the whole civilization. And we don't even know how many ghost hidden programs that are already embedded in things like our power grid, our bank computers, and so on, just waiting a command to activate them. By the way, I don't know how much longer we have to go with this. I would like to give some of your listeners absolutely free a copy of our new book. And by free, I mean we'll pay the postage, we'll pay for the phone call, we'll obviously pay for the book. It's a 256-page, heavily documented book. So if people would like a copy...
Yeah, I want, if you don't mind, stay on a bit. We'll be right back.
Love to. Again, because it's shockingly informative. But the problem is, we have built a completely artificial economic structure here out of the Fed and the income tax. We have, for example, a world where you can't win from your bank because the government and Fed are practicing the formal economic term, financial repression. They are deliberately holding the rate you're paid at the bank below the rate of inflation. And what that means is inflation is eating up your money faster than it's being replaced by interest. You are literally losing money every day that you have your money in the bank account. And that's all by deliberate, calculated government policy. It gives them the headroom to print money. Then they spend the printed money they've made, and by the time it gets down to you, it's lost part of its value. The government we have called an inflatocracy because they practice deliberate inflation. In fact, the Fed boasts that its objective is to generate 2.5% inflation, which is interesting when you realize that inflation is just a synonym for theft. So the Fed is really saying, we're planning to rob you of 2% of your money every year by deliberate policy.
So we have basically a collusion. Yeah, it's a collusion between the Fed, which is private bankers, and the government to suppress the value of the dollar and to maintain a negative value by manipulating the currency, by spending more money into the economy than the economy produces.
So, the Fed is private bankers, but they are the two heads of the Federal Reserve are appointed by the president. And they do work very closely, hand in glove, with the government.
Oh, absolutely.
On financial policy.
Absolutely. The government, when they want money, they rather than create it directly, as in the U.S. Treasury, issuing currency
and also, although
they go to the Fed.
Yeah, although we're supposedly rolling back quantitative easing, the reality is the Fed is committed to keeping interest rates close to zero. The government absolutely needs that. I mean, every 1% that the interest rates rise could be another $1 trillion a year in interest the government has to pay. So it would bankrupt the government if we went up to our normal 5 to 6% interest in the economy. And therefore, it's vitally important that the Fed keep it down.
I understand that, but would there not therefore be a solution which would involve the government simply issuing its own currency interest-free directly? I mean, that's what Lincoln did, as you pointed out, with greenbacks. I know that you don't see that as real money, but nevertheless, Lincoln wasn't the only one. Kennedy was planning on an issuance of a direct currency out of the Treasury backed by silver.
Kennedy actually Kennedy actually did a small direct issuance. That would be interesting. But
James Madison did it to pay for the War of 1812. All right, we'll be right back. Century Banking. Get your free copy at 800-630-1494. Lowell, it seems to me that the government, the amount of the control of the value of the currency is the responsibility, I would think, of the government, and that currency ought to be issued interest-free to reflect production. It shouldn't be, money itself shouldn't be a profitable item to anyone. Profits should be made by companies and by individuals, but money itself should simply be an objective and abstract means of exchange and a storage of value. That's what was talked about by the great 19th century monetarist Alexander Delmar in his book, The Science of Money, which is really an excellent source. And that basically the government could simply issue currency. I don't know how they could do it in a way that would be honest. That's a big question. Out in the open, Congress debating, simply to cover the amount of money needed for production, nothing more, nothing less, no interest paid to the Federal Reserve or any other bank. The banks would have reserves at hand that they can then lend, not make money from issuing their own currencies, as in fractional reserve banking, and that simply the money would reflect the value of our economy. Nothing more and nothing less. I mean, am I being utopian here, or is there a way to do it?
The very word I was thinking, and I'm descended from French utopians. So actually a good book for you to add to your reading list is Friedrich Hayek's Denationalization of Money, which you can get free on the Ludwig von Mises or the von Mises.org website. Hayek, who was a Nobel laureate economist and an Austrian, believed that we should simply have the freedom to choose what money you wish to use. You shouldn't be limited to U.S. dollars. If you'd rather do business in the euro or some other currency or gold directly, you should have the right to do that. Of course, that would then take away all the power that accrues to the government from forcing you to use their currency. To say, for example, that U.S. taxes can only be paid in U.S. dollars, and therefore you're forced to live your life in U.S. dollars. As to the greenback and making our own currency, one of the theoretical justifications for the Federal Reserve is that it would to some degree depoliticize the money. That is, it wouldn't be politicians making the decisions as to how much we'd print.
Right, it would be, but it should be politicians.
And I'll tell you about Abraham Lincoln, Secretary of the Treasury, when we come back.
Chuck Morse speaks.
Thank you very much. My guest is Lowell Ponte. Don't bank on it. It's Unsafe World of 21st Century Banking. I mean, Lowell, isn't there a way that we can get a national currency that is a reflection of our nation, an honest currency that's a reflection of the honesty of our people, that's interest-free? I mean, is it really something that has to be handled by the private bankers who manipulate it for profit and who manipulate it for social engineering reasons?
Prior to the advent of the Federal Reserve, which was a political exercise, we did have a gold-backed currency. In fact, the great debate leading up to that, in which gold won, was a debate between those who favored silver, which was a cheap form of money, and those who favored gold. And, of course, the reason so many hated gold was if a lender lent you $1,000, you'd have to pay him back a true $1,000. And people didn't want to do that.
But the problem with it was, the problem was that the gold was controlled by the big owners of wealth who could manipulate its value, and that there wasn't enough gold, which led to the various depressions, like the one that occurred during the Grant administration.
And this is why Hayek wanted denationalization of the money, so you could choose different kinds of money you would live in. You wouldn't be stuck with only one currency. By the way, one thing that came out of that era was the Wizard of Oz. Most people don't realize L. Frank Baum had been a newspaper editor in the hotbed of progressivism and the progressive arguments in favor of silver. And so, for example, in The Wizard of Oz, Dorothy's slippers were originally not ruby, they were silver. The word Oz itself stood for ounce. They were going down the yellow brick road. The whole Wizard of Oz was basically a metaphor of the debate between gold and silver at the time.
Right.
So it's fascinating to study that. But you were mentioning, why don't we go back to the greenbacks of Lincoln? In the near front of our book, The Great Debasement, this is our 2011 book, The 100-Year Dine of the Dollar and How to Get America's Money Back, we quote at length from Hugh McCullough. Hugh McCullough was the Secretary of the Treasury under Lincoln and Andrew Johnson. In a speech he gave in October 1865, he basically said the present incontrovertible currency, that is fiat greenbacks of the United States, was a necessity of war. But now that war has ceased and the government ought not to be a borrower, the currency should be brought up to a specie, that is gold and silver standard. And I see no way of doing this but by withdrawing a portion of it from circulation. I have no faith in a prosperity, he said, which was the effect of a depreciated currency. He warned that if Congress did not soon leave the greenback and go back to real money, there would be a widespread or a brief period of hollow and seductive prosperity caused by the easy money, he said, but it would result in widespread bankruptcy and disaster, and that it would turn business basically into gambling and speculation in the country, which has always been the effect of this kind of easy paper money. So Lincoln's own Secretary of the Treasury disliked the greenback and saw it only as an emergency measure that could lead to all kinds of mischief.
Well, of course, the greenback was inflationary. It was issued to pay for the Civil War, as you point out, and admittedly so. But does it really matter whether or not the currency is drawn back to a level that reflects production, whether that currency is paper or gold? The important the relevant factor there, I think, is the fact that there was simply too much money circulating in the economy, not whether it's a specie or whether it's commodity or whether it's paper.
Yeah, Chuck, the relevant factor is, would you rather have money that politicians can run off the printing press anytime they want, or would you rather have money that they're unable to run off the printing press because it's anchored in gold or silver? The whole purpose of
I would rather have money.
Go ahead.
Well, I mean, to answer the question, I would like, and I don't know the exact answer to this. If I did, I'd get a Nobel Prize. But there has to be a way by which the government and Congress can issue currency that is not manipulated by greedy politicians or by private bankers who control and corner the market in gold. I mean, it seems to me that there has to be a currency that is issued in a way that there's no incentive to inflate it.
Well, Friedrich Hayek did win a Nobel Prize, and his solution was let currencies compete with each other, because only by competition is there an incentive for them to be honest and of higher quality. And then people can make up their own mind and use whatever currency benefits you today in your spending. But, of course, because money is a major source of political power, the politicians don't want to give up their effective monopoly on who can issue money and who can't. And they want as much money as they want issued at any given time. They've already run up enough debt that we can never pay it off with honest money. They'll have to monetize the debt. They'll have to pay the debt by running the printing press.
No, I get that, and it could be reined in perhaps by a balanced budget amendment and by a separate entity within government, maybe a monetary commission of some sort,